Simon, welcome to the show.
Charles, thanks for having me.
Great. We're happy to have you. So we find you in London, is that correct?
Correct, in the middle of a heat wave, and it's fantastic.
Well, a warm London summer is better than a cold one, I would imagine. So, haven't been there in a while. Look forward to going back soon. So, anyway, the reason we're having you on today is you're the founder, co-founder, I guess, and CEO of SmartWage, which is a earned wage access platform, and we're going to get into what that is and what kind of business that is in a minute. But let's just begin with a little bit about your background. Just kind of walk us through. You're based in London, but you're from South Africa, and I assume. And should talk about your early career, kind of what led you up to your becoming an entrepreneur.
Great. Well, I grew up in South Africa, as you said. I went to university in Stellenbosch. Took a year off traveling. It was probably quite a pivotal point for me, and then moved to London early 2015 to work at Deloitte, and I was in finance for about 4 years there. Did a fair bit of traveling and sort of got experience in, I guess, learning how business works. But quite quickly realized that my passion was really kind of figuring out how to solve problems in interesting ways, and kind of started working with a bunch of startups early on in my career, and realized it was something that I wanted to do. And sort of the bridge came when I left Deloitte and went back to South Africa to work for a student accommodation marketplace called Digs Connect, and that was really the blossoming. That was where I got excited about the potential that a startup has, a team that's nimble and passionate about what they're doing to actually make a big difference in the world. I then worked with a couple of other startups to help them raise capital, and quite quickly stumbled across earned wage access and realized that was something that South Africans desperately needed, and that I could build a team that could do that. And so that's what we've done, or what we're trying to do.
Okay, let's go back to stumbled on earned wage access. Tell us a little more about what that stumbling experience was all about.
So a company called WageStream, which is kind of the market leader in the UK. It's been around. I think they founded in about 2017, but in mid 2019 they raised their Series A, which was about $51 million. And at the time, I was speaking to a friend of mine who was on the VC side. There was 6 VCs vying for a spot on their cap table, and she came across and told me about this wonderful idea. And I thought, the first question I had was, why wasn't this everywhere? And that was the moment I sort of thought, And you do the mom test and go and tell a whole lot of friends about this concept of earned wage access, and I have, still to this date, I haven't had anyone say, that's not a good idea. Obviously there's nuance to it, but
Sure, of course.
there's very few ideas that have that kind of potential.
And you think it's just pure luck that no one had done it yet, or just good timing?
Well, there was a couple of people doing it, but
Okay.
I think applying a concept, earned wage access as a concept, has been around in the States since 2011, and in the
Right.
UK since 2016, 2017. But applying it in an African context where you have heavy data and device constraints is very different. And so, while there are a couple of competitors doing it, we realized you had to do things very differently to try and adapt the product and the solution to the South African market, or within the African context.
Okay, so we're going to get into that in a minute, but let's start at defining why this is such a big need in South Africa.
Well, I think maybe kind of taking a big step back, financial inclusion is something governments talk about. It's something a lot of fintechs are trying to solve. And if you look at the industry, you've got a booming payday lending industry. We've all heard the horror stories about what people get charged. And the reason why that industry exists is because the 30-day pay cycle hasn't been challenged. It hasn't been challenged for 100 years. 100 years ago, you worked a day, and at the end of the day, you got paid your cash. And today it's 30 days. And now, unfortunately, there's a large part of the market which is underserved. So halfway through the month, you need money. Most people go to payday lenders and loan sharks, and it puts them in this cycle, which unfortunately becomes very difficult to get out of. And that's
You need another
really
payday loan to keep
exactly
because that last one ate up all the earnings. Yeah, yeah, right.
And so that's really where it's come about. And unfortunately, because of the risk involved with that, the rates that people are charging are very, very high. And so earned wage access really changes consumer risk into corporate risk, and does so in a way that benefits both the consumer and the business or the employer.
And the 30, the question, because earned wage access platforms exist in plenty of places where there isn't a 30-day wage cycle, right? Where there's a 2-week wage cycle. So that's not the requirement for this model to work necessarily, right?
A fixed pay cycle. So in South Africa, you've got
cycle.
80% of employers are sort of on a fixed pay cycle, being 30 days. We've got companies that are offering, weekly salaries or bi-weekly salaries, and the same problem exists. It's just not as big.
Right. Got it. Okay. So let's get into sort of how the business works. So a good place to start is who's paying for this?
So it depends. It depends on, we typically encourage employers to pay. South Africans, it's going through a tough time at the moment. As you know, employers are not really that keen to pay, but we do have a bunch of employers. So the answer to your question is it depends, because it's either the employer or the employee, but someone does pay. If it's an employee that pays, typically, and it's across the board, all of the earned wage access providers are circa sort of 5 to 10 times cheaper than a regulated payday loan alternative, and a whole lot cheaper than your unregulated alternatives. And yeah, typically, the progressive, innovative employers who understand the benefits that this gives an employee end up paying for the solution themselves.
Okay, and so let's just get into that a little more. So I'm an employer. I choose to pay because I see the benefit and all the benefits of having a happier, more stable workforce, et cetera. I feel it's worth me paying for it. So what is it? A subscription plan? Is it a per incident? Et cetera?
So yeah, absolutely spot on, Charles. So we're at the moment, it's a subscription fee. It's a fixed subscription fee per person, per registered active employee. We're actually potentially changing our model because unfortunately we have varying degrees of salary ranges. We've got those that earn 3,500 Rand a month and those that earn 20,000 Rand a month, both operating on the same model. And so unit economics don't necessarily always tie up. What is quite clear is that the consumer is willing to pay a fair bit. And so we're trying to find the line between making enough margin to keep a business going and have a decent business while being very responsible. How can we offer this to employees in ways that they benefit at the end of the day? Ultimately, if you think about the long-term benefits of this model, if we aren't benefiting the consumer, the businesses will kick us out.
So I'm inferring that the easier path for you is to charge the employee versus the employer.
Much easier path.
Yeah. So, okay. So, and what you're trying to do is find that sweet spot between margin and being too close to the usurious pay, right? So, yeah, it's kind of finding that happy. What is that process like, and how close are you to figuring it out?
I think we're, it's a super early market in South Africa. The market's very nascent. Most employers that we speak to haven't heard of earned wage access before. The couple of employers that took up our product early on are the early innovators, and in fact, all of them have switched over from the employees paying to the employers paying, which is indicative, hopefully, of what will come down the line. They're starting to see tangible benefits for their staff and for their employees. But the conversation up front, especially if you're going into a competitive bid, one's charging the employee and one's charging the employer, becomes quite a difficult sell.
Okay, so you're up
unless you have a very, very
anything, right?
Correct.
Versus that's always the challenge, right? Even if ultimately that's not true, or maybe it's not in the long-term best interest of the business, it's much easier to say yes to the thing that costs you nothing, right? So that's
exactly
your big competitive challenge. Okay, so but just quickly back to the employee. What now? Is it a fixed fee? Is it a percentage basis?
So we operate two models: a subscription model, 30 Rand per registered employee per month, that unlimited transactions, and a minimum amount of 100 Rand. We cap the amount that you can access at 25% of what you've actually earned. Right. So if you've worked for 5 days, you've only earned 5 days of earnings. And the other model is a 3% transaction fee charge, so 3% on the amount advanced. And we've got employers on both models.
Okay, but this is the employee paid or the employer paid? I'm sorry.
Again, both.
Okay.
So
Either
for
way, it's the
both
same
models,
amount. Okay.
and in fact, there's a hybrid of both as well.
Okay.
So in some instances, the employer pays half the subscription fee and half and the employee pays half.
Okay.
Interestingly, in the States, there's a number of models. You've got models where it's completely free. You've got some of the platforms do donations. That doesn't work in South Africa. But yeah, I think there's a number of ways. There's a high demand for the product in the hands of the employee, less so in the hands of the employer as it stands.
That's becoming clear that there's an easy path, and then maybe there's ultimately the correct path, right? Okay, so the big question I have is kind of behind the scenes. These earned wage is the important piece here. It's money already earned. It's not future wages; it's earned wages, right? That money has been committed, right? But where is the money and who is fronting? Are you fronting the money? Is this a finance play, or is this just the employer providing how does that, the part we don't see, how does that work?
Great question. So we integrate with an employer's payroll system or time and attendance system to understand exactly how much someone's earned at any point during the month. Those integrations can be semi-automatic. When I say semi-automatic, it's essentially flat file integration where you're uploading CSVs and exchanging data on a regular basis. And the second part of the integration and preferred path is an API integration. But every system is very nuanced and very complex. So that's how it typically works. SmartWage or in fact all of the earned wage access providers are fronting the money ourselves. So we've got a debt fund that funds the advances, and the same day that an employer would pay their employees, they pay us back.
So it's like buy now, pay later.
It's exactly, buy now, pay later is essentially disrupting what we're doing, because why do you need access to your money if you can buy now, pay later? Except that buy now, pay later is limited to certain things.
Right,
and
it's
often,
not for everything yet, though. It's being applied to more and more things. Every day I see a new application of BNPL. But the point I was making is about fronting the purchase, basically. In your case, you're fronting the wages. So talk about the big challenges for this business, because my first thought is you're using debt to pay for their wages. Now you're getting reimbursed. I assume the fees cover your cost of funds, right? But it sounds low margin. So talk to me about
Well, I think the first thing is, as I mentioned early on, it's sort of swapping consumer risk for corporate risk, right? So you have very low defaults on the corporate side, and the turnaround is typically pretty small as well. So the second or third week in the month is typically when most of the advances happen. At payday, usually between the 25th and 30th. So you're only actually facilitating essentially or taking out debt for a short portion. The real challenge for us is getting big employers to understand the benefits of the solution. And the second part is then getting the solution into the hands of employees. South Africa is a relatively financially illiterate population as well as digitally illiterate population, and have been taken advantage of for the past 30 years by payday lenders and mashonisas, and so are very skeptical of even the best financial institutions. Okay. You often see people lining up at the bank at the end of the month because they were, withdrawing all their money because they're worried the bank's going to take all their money. So there's an inherent skepticism there. So introducing a new concept and a new product, unless we have a significant amount of trust for our users, is very difficult. On the point of, what makes this an interesting proposition from an investor standpoint is once you get distribution and once you build credibility with your user base, you become the trusted source of where someone looks to when they look for money. So, I need money, where do I go? SmartWage. And that means you have the ability to upsell a number of financial services products or investment products down the line.
Okay, that's where I was going to take it next, is like this is great, but
What
what do you add
next?
on to it to add some scale and to add some, to get more out of that average customer uh, spend or whatever it is. So talk about so like a Robinhood like investor product is another potential application.
Um, I'd love to say yes, but in South Africa, that's I think that's a slightly well. Let's take a step. We're kind of going after a relatively uneducated
Okay,
population
that's a
who,
step
yeah,
further
it's a
than
step, it may be a step too far, but
yeah, yeah,
offering
okay.
insurance products or very basic investment products or savings products that are understandable by the target market
Hmm.
and are easily accessible is where we're going. So, we've got someone who's used our product for 12 months and we say, hey, would you like access to a funeral insurance product that's currently 3 times cheaper than your product? Or
Okay.
would you like access to a term loan if they need a term loan? Now the key part here again is we have the payroll deduction, which means that we can reduce our risk on the lending side on a loan
Because
facility.
you can get first in line, sort of.
Correct. And
Yeah.
if you think about what neobanks are doing, the biggest problems that some of the best neobanks in the world have is that they are struggling to get salaries deposited into their accounts. So they one way around that is to partner up with companies like ourselves to get people depositing their salary directly into the account for free, and then you can make money on a typical way of backward interchange and so there's a number of ways to monetize down the line. The key is getting the distribution early on.
Okay, so this is a distribution game now. Could you be successful just doing the EWA piece long term? Is that interesting
Yeah,
to investors long term, or
it
is
certainly is. We
yeah,
initially, our initial proposition was charge very low for EWA and monetize down the line. I think something that probably works a bit better in the States that it does in a low capital environment like South Africa. Um, it's the unit economics are pretty amazing actually with just EWA, but down the line you want to be the most affordable product in the market and you want to really build trust with your users. And ultimately, our ultimate goal would be able to upsell using additional products in future. So the EWA product is the starting point. It's profitable, but uh, the big ticket is the ability to upsell
if I'm
additional
an
products.
investor, that's what's getting my that's what's
Yeah,
getting me to lean in and listen. Is
exactly.
that opportunity? Okay, that's fair. What we probably haven't talked about enough, we can get into a little bit, is this notion of what's in it for the employer. We alluded to it, but there is a whole conversation about how much they would benefit from having, a workforce that isn't, you know, accessing payday loans and having that degree of financial instability in their lives. How much of that have you sort of documented as a benefit to the employer and is it resonating? But talk about that a little bit.
So, I mean, the first thing is, stressed employees, financially or otherwise, are not productive, regardless of what environment they're in. So, if we can reduce that stress, obviously there's a benefit for the employer. But what actually, interestingly, what we found is we've got a lot of people who dial in just to check their balance, just to check how much they've actually earned. And the key sort of benefit for an employer is productivity. If I had to ask you, Charles, what do you earn on a daily basis? Most people can't tell you, but you're now starting to see how much you earn every day, and you realize there's this correlation between work and pay, and so there's an increase in productivity off the back of it. Every day worked is another day I've sort of earned money. But the big one in South Africa, again, for the target market we're going after, is absenteeism. The number one cause of absenteeism in South Africa is no money for transport, which talks to the problem we're trying to solve, and this solves that problem. And so we've started to see a significant increase in the reduction in absenteeism at the employers we're working with. And on average, we estimate we're sort of saving employees about 300 Rand per month that they would have alternatively spent on payday lenders. We're trying to quantitatively understand from our users, what's happened to their spending behavior and their budgeting behavior since using SmartWage, and the results are very promising. And interestingly, if you think about, we give people access to 25% of their net pay. Most people are accessing just less than 11%.
Okay.
And so it's being used relatively responsibly with about 2.5 advances per month.
Okay. So it's go. I've read different things, but talk about where the main things that it's being that early access to funds. What's it being spent on?
So one of the questions we ask our users at the end of every journey is, what are you spending the funds on? And over 30% is transport,
Yep.
and close to 30% is groceries. And then the next biggest expense is emergencies. Now, this is self-reported, so it's very difficult to
Right. People may
ascertain how,
de-emphasize certain things, but it's probably broadly accurate, right? So, okay.
exactly.
Yeah. It's
And then
interesting.
obviously the system obviously flags up those users that are potentially using it every day or have taken maxed out 2 months in a row, and we then flag those users and actually try and deal with them separately. So we're trying to add additional services. We've got a debt consolidation service with one of our partners that works free to the employee, free to the employer, and actually works with a distressed employee who we recognize through our system to try and figure out what debt obligations do they have and how can we work with this person to solve it.
Hmm.
And over time, you try and do this all in an automated fashion.
Okay. So, what kind of partnerships do you envision? You kind of alluded to the neobanks, but what kind of partnerships could make this business stronger? Or anything you can talk about that's in the works or on your
So
thinking at least?
we've been approached by a couple of sort of larger financial institutions who,
Hmm.
as an example, a bank would as for the reasons mentioned earlier, it's a great product. If people are struggling to get deposits paid into bank accounts, and we can facilitate instant access to payments, because South Africa's banking infrastructure is relatively legacy, instant payments are not really, they are a thing, but there is a significantly there's an extra charge. So employees typically, if they request the money today, they get it tomorrow. And so as a bank, if we use the same rails, it's a fantastic way for banks to, swap bank accounts. We've looked into a bunch of employer benefit providers. So companies, aggregators that work with employers to provide, medical aid schemes or other employee benefits. And then the last one is insurance. Same thing, thinking about distribution through a number of ways. And again, exploring interesting conversations with providers who essentially have existing distribution and recognize that the people that they serve would need access to this. The key being access to payroll systems, which is a tough nut to crack.
Hmm. Are most big employers using a third-party payroll system? I imagine so.
Using a third-party payroll system with an in-house payroll team.
Right. Okay. So, everyone always hates this question, but what are your biggest risks? You're a disruptor in a way, but who can disrupt you? There's always, if you're starting an e-commerce business, you always, how can you, live in an
No,
Amazon?
it's
So what's the equivalent question for you, I guess?
so I think the biggest risk is that your largest payroll providers start providing the service themselves. So how do they, how does an ADP, a Sage, an Oracle begin to do it themselves? And you are starting to do some of them do it. However, it's a completely different business model. They are B2B. They've now got to take on a whole B2C angle, B2B2C angle, which is completely different to what they've previously done. And I haven't seen any big players do it effectively. I guess if I look to the
Well,
States, someone like,
can I just stop you there? Why is that? I remember I've had conversations with SME lenders, and they talk about how big banks just can't get their heads around small loans, right? Is it a similar kind of challenge? Talk about why is it so hard for them to do that? It seems like it wouldn't be.
I think it's a fundamental pivot to their business model. They
Hmm.
typically have these sort of outsourced, they have these consultants that go and find business and work with businesses too. And now they've got to go a whole further layer deeper to get to the employee.
Hmm.
It's a completely different model that would require either a sort of, they purchase someone and or acquire someone and plug it in, or building their own system. And it is nuanced. There are a lot of small things, especially in a South African context, that I think the big players are too slow to sort of move to. If you look at someone in the States like Gusto probably the
They do
best
this. Yeah,
example
yeah.
of
Hmm.
a payroll provider who
Mm-hmm.
have now moved into the space,
Mm-hmm.
but they are again one of the most innovative companies
Right.
in America, and it's taken them a couple of years to get to this point, whereas it's been around for 8 or 9 years. So I don't foresee the biggest payroll providers making a big change to this. We estimate there's about 5,500 businesses that fall into our target market in South Africa, and that's dispersed amongst a handful of payroll providers. But each payroll provider, Sage, for example, has 10 different Sage systems, and so it's
So
relatively
Sage,
complex.
they're more likely to try to acquire you than to build it themselves.
I would think so. And interestingly, actually, there's still a lot of on-premise payroll systems, so they haven't even migrated to the cloud yet, let alone thinking about disrupting. So I think there's still a few steps behind.
Okay, that's fair. So a few more questions around your business. One is, so, well, first of all, what is your path to scale, and how much are you going to have to raise a lot more money? Are you sort of in the process of raising another round? Kind of talk about that as much as you can.
So path to scale is raising some more money as a starting point. We've built a great team so far, but to really scale, we need to raise a significant debt fund, and we are actually in the process of going out to raise. We'll go out in the next couple of months. It took some time for us to get the technology right and to learn exactly what the consumer wants. Again, talking to the nuances of what a South African digitally illiterate low-income worker needs to use in order to use the product. One of the big blockers to scale is, again, the ability for us to convince users in that low-income bracket to use the product. And so there is while digital activations certainly work, they only work to a certain extent, and we actually have to go on site and undertake digital activations. So in certain environments. But the biggest risk at this stage is the big B2B sales, finding South Africa's largest listed entities with tens of thousands of employees and convincing them that this is a product that their consumers or their employees need. And I think it'll take a couple of years before the market properly turns.
Right. And you're going after reasonably sized enterprises. Is there a smaller business play for this? Is it just too hard to sell into that market? Is it too hard to serve someone who has 10, 20, 30, 50 employees versus?
It's actually much easier to sell, much easier to sell, but the administrative burden behind signing someone up, and then the risk as well of those, the risk of taking on a smaller SME that may not have the right processes in place or pay their employees on time, or is too high. So we only work with companies with 200 or more employees at this stage. Down the line, a sort of a self-checkout option once the tech has evolved.
It has to be like a SaaS layer or something that you can do that makes this more self-service for them.
Exactly. But that's down the line. I think if we look again to the dynamics of the South African market, you've got sort of 9.7 million employees out of the 15 million formally employed that sit within the 200 plus employer market. So that's where we're targeting. Right. And we're going after sort of hospitality, retail, mining, manufacturing as a starting point.
Yeah, no, that all makes perfect sense. And what about international expansion within the continent? I would imagine would be the first thought. How does this work in, I don't know, name a neighboring country or an East Africa?
We've had a number of inbound leads from Kenya, from Malawi, but unfortunately the first potential blocker is the work, the relationship between workers and their employees is a lot less formal. So how we pay people is very different. But you're seeing earned wage access players pop up all over the place. And once you've built the technology to serve a certain type of customer, we can scale this across pretty easily. We haven't scratched the surface in South Africa, and I think it would be premature for us to start thinking internationally.
But is it
even in
is
Africa?
it on your long-term
Absolutely. Yeah. I mean, I think Nigeria and Egypt would be the next two jurisdictions to
Hmm.
go after if we manage to crack South Africa.
Okay, interesting, interesting. So let's talk. Here's a question that you can't really answer, and it's unfair for you to answer it. But I read something a while back where someone said it was on LinkedIn or someone posted something. Stop talking about uh, unbanked or underbanked and start talking about underpaid. And the point was that the problem, the real problem to solve, isn't access to financial. That is a problem to solve, but the bigger point is that so many people are so poorly paid that they need these things. I know that's not your problem to solve, but is that something that you think about? It's like we're kind of putting band-aids on bigger problems. May be unfair to ask it that way, but you must think so.
No, I mean it's a great question, and unfortunately there's nothing we can do about that. But I guess if you holistically look at this and say, well, you realize that the people who are underpaid are also being underserved by players like ourselves because we're focusing on, a lot of companies are focusing on building fancy apps and this,
Right.
and going straight after, again, to like we are going after corporates or bigger employers. What's happening to the SMEs who still have 30-day pay terms or 30-day, and those are in fact the companies that need it most, not the 200 plus companies with, those are likely the higher paid employees. So you're right in saying that unfortunately underpaid is the first part, and then underserved by not just all financial institutions, but even startups because of our lack of access and the risk, quite frankly.
Hmm.
Um, Hopefully with the advent of sort of 5G and the ability for data costs to come down and device costs to come down, Africa starts to pick up, or adopt quicker than it currently is. I think we'll see that change. But until it
Hmm.
does, I think we still have a significant issue on our hands.
Fair enough. Fair enough. So let's ask a couple broader questions. How would you describe the startup environment in South Africa now? I mean, it's obviously very active. Among within the continent, it's one of the top two or three markets for investment in new companies. But what could be better for companies to launch in South Africa from a regulatory environment, from a whatever all the major components that make it easy or hard to start a business.
I mean, having lived in London for a couple of years, that the difference in access to capital is significant, and I think that's the starting point. Is there's
Hmm.
reduced access to capital, and unfortunately, for most entrepreneurs, finding the right investor is probably the biggest hurdle. And investors want to take a big chunk early on at very low valuations, which then disincentivizes the the founders. So that's, I think, the first one. But the second one is talent. With the advent with COVID, a lot of talent are now are being poached by international companies, especially in the
I hear
development
this a
scene,
lot.
who
Yeah.
can who
Yeah.
can play who can pay double what we can, and we don't really have an option. And so you lose out on a lot of significant talent. Amazon moving, opening up in Cape Town is a fantastic thing for the ecosystem, but it's they're literally paying double what we can afford, and so access to talent is tough, and then retaining that talent's even tougher. And so I think to incentivize people, yeah, I mean, Section 12J, which is the UK's equivalent of SEIS or EIS, is now being stopped, which is what it was a fantastic scheme to incentivize angels and to invest in startups. That's now completely stopped. So I think the government needs to step in and really incentivize and give people easy ways to start businesses. I saw a great thing the other day. So SAA got bailed out for 10 billion rand. That's equivalent of giving 100,000 entrepreneurs 100,000 rand. And I thought, if you think about it that way, I think we'll get a lot more economic activity out of 100,000 people than we
Right.
would out of
Right.
SAA. So yeah,
The myth
access to
of too big to
capital and
fail.
talent.
Right. Yeah. Yeah. Interesting. Interesting. Cool. So if you were starting another fintech company today, what area? Not that I'm saying you should leave earned wage access, but let's say you were. What do you think the most interesting sort of bubbling up opportunities in fintech are? Or maybe even broader outside of fintech, but sort of in that broad space.
Great question. I think Africa, geographically speaking, as a starting point, is still completely untapped. And I think there's a lot of business models that you could apply from the US and Europe to Africa. In terms of a specific business model, I actually don't have an answer for you, but I think the use we are still operating on very old school models in so many different ways. The way we pay is one of them, but the way we deliver, the way we fly, the way we book, the way we do anything in South Africa and Africa is 5 to 10 years behind. I really do hope that 5G and AI levels the playing field, but I worry it does quite the opposite. So until we sort of educate our workforce and give them tangible skills that they can use, I think Africa has a hard road ahead.
Yeah, yeah, yeah. So, given COVID and everything, how much time are you spending in South Africa? I imagine not as much now as you'd like to.
No, I was actually meant to fly back 2 nights ago, and obviously because of the protests and COVID, I didn't. But I should be there about half my time. I was back for about 4 or 5 months over summer, and I've been back once or twice since. So I tend to go back in normal times, sort of once a month or once every 2 months. But at the moment, unfortunately, it's been a couple of months since I've
Yeah.
touched ground on home soil.
Well, I think by the end of the year, things should be better. I would hope.
It's up so.
Yeah, yeah.
It's up so.
Well, thank you very much for your time. It's been a pleasure speaking with you and learning about your company.
Thank you, Charles. Thanks for all the questions. I appreciate it.